Welcome back to the Investing on the Go podcast, brought to you by Fund Caliber. This week, we're focusing on the high yield bond market and how inflation and the threat of recession alter the opportunities for investors.
I'm Chris Sarley, and today we're joined by Mike Scott, fund manager at Man GLG. Thank you for joining us today, Mike.
Good afternoon. Thank you.
Lots of investors have been pushed into high yield because of super low interest rates, and that's sort of led to very little income from government and corporate bonds. But is this changing now? And what essentially is the traction for high yield bonds in the market at the moment?
That's a very good question, and I think certainly over the past decade, you're right. Yields in the market were low on a historical basis across government bonds and credit, and much of this was driven by disinflationary trends and very dovish monetary policy from the central banks. Now today we see this is rather different. Inflation has obviously has reared its head, and central banks are looking to counteract that by raising interest rates, and that has seen yields in the market across fixed income rise. So actually, yield or the return potential of the asset class has increased. So that's first and foremost. But most importantly, I would say, is understanding the credit fundamentals themselves of the businesses, because there's two aspects to the return within high yield. It's both the underlying government bond and the credit spread, and it's really the credit spread which is the major driver of returns through time. Actually, if you were to look at the yield of a high yield bond, typically 80 to 90% of the return potential is from the credit spread, as opposed to the government bond yield. So therefore, what is changing now? I mean, clearly we're in a higher inflation environment, but also potentially a weaker growth backdrop, and this has seen spreads rise in aggregate. Now, I would say that what this environment really investors should really pay attention to is the underlying credit quality of businesses and the ability of those businesses to generate cash flow in this environment will really differentiate returns for investors.
The high yield market is usually synonymous with the US energy market. Could you maybe go into why that's the case? And with the oil price being so high, does this mean the sector is in much better shape on this occasion?
Certainly, it has exposure to the oil-related corporates in the asset class. I mean, typically, as you look at the asset class today, about 15% of the market is US shale oil and gas producers. That has meant that this segment of the market has a quite high degree of sensitivity to obviously hydrocarbon prices, whether that's gas or oil. And certainly over the past decade, we've seen significant swings with respect to those prices, and that has brought different credit backdrops for this segment of the market. Now today, there's been significant supply side issues with respect to oil and also the supply of gas, not least inflamed by the tensions and war in Ukraine. The flip side of this is that oil and gas prices remain elevated, and this means that these particular segments of the market are clearly able to generate stronger cash flows than in a lower oil and gas price environment. As credit investing goes, it's really about cash flow and the ability of companies to generate cash. And in the current environment, U.S. energy corporates are generating a high degree of cash flow, and that in terms of the question, certainly sees that these credits are in better better shape than say where they were during the COVID period or indeed prior to that in sort of 2015.
If we enter a recessionary environment, how is the high yield market likely to react, and what's the case for holding high yield in this type of environment?
Well, I think there's a very important element of investing in high yield is that you're investing in businesses and the cash flows of those businesses that those businesses generate, because that's really what is used to pay the coupons and effectively refinance the debt. So in a recessionary environment, certainly cash flows of businesses typically decline, particularly for the more cyclically orientated corporates. And this means that the risk of, or the credit risk of these businesses rises. And typically during these periods, you see the expectations of corporate distress or indeed defaults rise. And this leads to higher risk premiums in the market, or what we would call the spread of the market. So as we go through a weaker growth backdrop, you should expect spreads in the market to rise in aggregate. Now, as we look at the market today, clearly there are some concerns about a weaker or an unfolding weaker growth picture, and indeed, the spreads have widened during this year, and potentially have room to widen further, if growth continues to weaken. That said, spreads are now trading at their median spread level over the market's history. So to some degree, the market is already pricing a weaker growth backdrop. Really what's important is to really focus on those businesses that can generate cash flow and stability of that cash flow through a weaker demand backdrop, as ultimately that is what is paying the returns on your bonds. And really what I think will differentiate good returns in the asset class will be focusing on more recession-proof businesses that are able to weather a weaker growth backdrop versus more cyclical credits, which the jury is still out as to how these credits may look in a recessionary backdrop. So what I would say is that this is a period to be selective. It's a period to really differentiate with respect to credit quality and businesses that are able to generate cash flow in a weaker demand environment. And that is certainly what you'd expect to see if we enter a recessionary environment.
You mentioned if we enter a recessionary environment, we're certainly in an inflationary environment at the moment. How does inflation affect high yield bonds, and does the high yield help mitigate the impact to a degree?
Again, very, very interesting question. It does in a broad sense. Now, why is that the case? Because nominal growth generates nominal cash flows, which pays nominal coupons. So obviously, with a higher nominal growth backdrop, i.e., with a higher inflationary backdrop, arguably cash flows should be higher. Now, that is not quite as simple as that, because ultimately, when you look at companies, you really need to understand whether a company has pricing power, for instance, or the ability to pass on cost pressures, which are certainly part and parcel during inflationary periods. So not all companies are created equal by any stretch. So yes, for those businesses that have strong pricing power, can pass on cost pressures easily, or have escalator clauses within their contracts, or are in fairly monopolistic industry structures, I would say have a very good ability to pass on those cost pressures. For instance, pharmaceutical companies or potentially consumer staple companies, I would sort of put into that category. Whilst businesses that are more cyclically exposed with strong cost pressures resulting from higher input costs or or labor intensity, i.e., having to employ lots of workers, I can see struggling in a higher inflationary backdrop. So it really is very critical, not just to think about the inflationary backdrop, but also to think about what businesses actually can flourish or potentially flounder from that inflationary backdrop.
That's great, Mike. Thank you very much for joining us today.
To learn more about high yield bonds and start your research on the elite rated Man GLG funds, please visit fundcaliber.com. And don't forget to subscribe to the Investing on the Go podcast, available wherever you get your podcasts. Please remember, we've been discussing individual companies to bring investing to life for you. It's not a recommendation to buy or sell. The fund may or may not still hold these companies at the time of listening. Elite ratings are based on Fund Caliber's research methodology and are the opinion of Fund Caliber's research team only.